Hey everybody, welcome. Rob Booker here. Today we're going to talk about gold, super popular, part one of two parts in a video series about trading gold with support and resistance. Glad to have you here. So as usual, if you want to work together with me and trade these strategies in an automated fashion, you can go to bookercall.com. The link is below this video. You can fill out the form, schedule a time to talk to us, and we can talk about trading these strategies together. Also, if you're interested in trading gold or FX, contact Forest Park FX to receive cashback rebates on every trade you place. Contact Forest Park FX at forestparkfx.com. Terms and conditions will apply. Forex trading carries a significant risk of loss. Let's get into gold. Gold's super popular, and in this video today, I'm going to talk about the simplest form of trading gold, but with a couple of caveats and warnings that don't come along with any other financial instrument. You see, gold's one of those instruments where people get long-term bullish. There's not a lot of super long-term bearish gold people. In addition to thinking that those people are idiots, it's just not likely or just not regular. So everything that I'm about to say is really going to focus on when's the right time to buy it, because I think that as of the time that I'm making this video, we're really in a long-term upswing and a long-term upward trend in gold, and we want to focus on that. However, if you're bearish on gold, I'm going to show you the example right now. So on the charts, what I have here are a few different types of indicators. The first are a series of dots above and below the candles. Now, some of these dots are green and some of them are red, and those of you that have followed me for a while know that a green dot is a bullish candle pattern for price action. So bullish would be a bullish engulfing candle or a doji or other kinds of things like that. And on the red dots, you already probably know that these are bearish exhaustion or price pattern candles. Bearish engulfing and so forth. And if you want to dive deeper into that, we can do some videos about price action in the future. That's number one on the list, and it's probably the most important thing on the screen right here for getting us into trades. But there are other objects on the screen here. One are downward pointing red arrows, and this is a bearish or a bear reversal tab that signals the market could be heading lower. And then there are also green arrows or triangles pointed upward, which are bull reversal tabs. And I can make sure that there's a link below this video so you can download those reversal tabs absolutely free. So you don't have to do anything. You can get that reversal tab indicator on your screen. The other thing that you'll see on the screen is a blue line for a daily pivot. And you will also see sort of an orange-ish line above, and in some cases below, for the daily R3 and S3 levels that accompany the pivot points. R3 is resistance number 3, and S3 is support level 3. And these are really easy to get up on your charts if you want to. You know what, I'll just walk you through this step by step actually. So I'm going to get rid of the weekly pivots. We don't need those. And I'm going to remove the daily pivots from the chart. And I'm going to put them on here step by step. So on tradingview.com, I go to indicators at the top of the screen. And then I just type in pivot. And I click on pivot points standard. And then I X out. I'm going to double click on the pivot point. It's going to pop up a box for settings. I want to go over to inputs and choose daily. Style, choose the pivot point, and I color that blue, and then put a checkbox next to S3 and R3 and color that orange or some color that I'm going to recognize. Now I've got everything on my screen that I need, and we're gonna really start cooking with gas here. So all I really need to see is for price to hit R3 up here on a given day, and then print for me a bearish exhaustion candle or a bearish reversal tab. In each of those situations, that gives me all of the confirmation that I need to pull the trigger on a short trade. If I've decided that bearish trades on gold are reasonable. Now, for many of you, they are not. I don't like bearish trades on gold either. We can talk about a few instances where I would agree to it. But let's say you're trading like gold futures, for example. So you're trading gold futures and you want to just get a few ticks out of it. You can get a few ticks out of this kind of bearish movement. It hits resistance level 3, which is totally rare, and then it prints an exhaustion bar or candle, and that's immediately go time. Now I'm looking at a 15-minute chart here, and I think a 15-minute chart makes a lot of sense for this system or methodology in particular. Now what's crazy is we're going to move forward a lot of days here on the chart, and it's going to take a long time before we can see another bearish setup, or bullish setup even. And it's days and days and days, even weeks later, and boom, we hit R3. But there's no red dot and there's no reversal tab. They're not there. But we had both of those just a little bit earlier on the same day. And so I would consider that enough information to go ahead, and if you think that shorting gold is reasonable, which some of you may not, past performance is not necessarily indicative of future results, all trading involves a substantial risk of loss and so forth, you might say, okay, the bearish indicators, the exhaustion bars or candles, plus the reversal tab, they precede the hitting of R3. So we can sell it for a few ticks right at that moment. And I think we're gonna be okay if we do that. And then we're just gonna move forward until we hit R3 and S3. Now this is a little bit of a weird situation. Watch this one. This is a holiday or something weird right here, this blue pivot. So all of this price action and hitting of R3 and S3 is irrelevant. But we do hit R3 over here, and we did print multiple other indicators before that happened. And price does drop from there. It goes up a little bit, but it does drop from there for a few ticks. And once again, I think in a long-term bull market for gold, you don't want to get caught holding on to gold shorts for very long. So we'll skip over that weird S3 and R3 that was all bunched together, and we'll move over to an example of where price, it's really hard to see, but price almost touches S3 or support level 3, but doesn't get all the way there. It's just within one tiny tick, and it doesn't hit it. You might decide to go ahead and take that position, buy that with half your usual position size, if you see a bullish candle after it hits S3, or almost hits S3. But I would probably walk away from this entirely. You might decide otherwise, but it's got to hit it. And if it doesn't hit it, then I'm not gonna take the trade. And then you'll just see weeks, days go by, and we don't hit these levels again until here. Now we're going to talk about taking this in a completely different, well, a different level of time frame and a different level of patience. So gold hits S3 here on the 18th of some month, January 18th, 2019, and it prints a bullish exhaustion bar in green. It's a green dot right here at the bottom. So that's a bullish engulfing candle, and that's go time for a buy trade. And it moves up just a couple of ticks, but not very much. And because I'm long-term bullish, I'm a long-term bull on gold, I might buy and hold. And I did. I'm accumulating a position in gold now, like as of the time I'm making this video. And I bought here, and I still haven't let go. I still have this trade on because I like it. Because I'm a bull, I don't care if it moves up a few ticks, which it does move up a very, very small number of ticks, but then it drops. And I'm super confident, not fairly confident, I'm super confident that I'm going to be able to hold that and watch things jump upward, which is exactly what happens. I'm super confident in being long gold, and I don't care that I had to hold on to it for a while, as opposed to, and this is such a perfect example of this, as opposed to this. It hits R3 just a week or two later, and I'm already long, and I'm holding that long, and I don't want to be out of that long, and I don't want to short it, and I never wanted to short it. So maybe I take some profit here. Maybe. And maybe I even short it if I'm willing to take both sides of the trade. I close out my long position, I take a short trade for a few ticks, but then I can't hold this very long. And you can see here the value, especially when it comes to gold, in having a perspective and in having a preference and in knowing which direction you want to be, long or short. Because I already was long here. I would never have even taken profit. I would never have even initiated a short. But let's say I had no position on, and let's say that I did take a short trade. Let's say I shorted gold futures, and I was going for a few ticks, and maybe I was trying to target halfway the distance to the daily pivot. And instead of going halfway the distance of the daily pivot, it just rockets upward. I might just go ahead and let that trade stop out. But the question is, where are you going to let it stop out? Where is this going to be where is too much? So I go back in time on my charts, and I just drop support and resistance level across the tops of bars or candles from a recent time. And that becomes my maximum stop. So just general principles of support and resistance. I've got lots of videos on the YouTube channel about support and resistance. First of all, I hated the trade. Second of all, if I took the trade, I'd want to make sure that I had a stop loss in place. I bet you this level gets hit again, this purple level on my screen, because support and resistance level had been hit so many times. So let's wait for another level, R3 or S3, to get hit. Okay, this is a great example of a ghost hit. And I'll tell you what I mean by this. So this is R3 on the 6th of February. On the 7th of February, price actually finally hits that level, but it was yesterday's level. So it's kind of like a ghost S3 level. Excuse me, S3, not R3. I apologize for that. An S3 level. That's enough for me, because I am bullish, because I want to be long. I would never do this for the short side, but I want to be long gold. So I want to take this trade. In the case of that, the next day I pull it up and there's this bullish exhaustion bar plus a bullish reversal tab. I love buying it, even though it hit the ghost S3. Yesterday's S3 hit today. I want to do it, and if I were bearish some financial instrument, I would be willing to trade based on yesterday's R3, just in reverse. I love that trade. I love, because I want to accumulate buy positions and hold on to them for a long time. I'm willing to do that. So here we come to the present day. And here we are at present day, and gold is just shooting upward today through R3. It hasn't printed. There are no red reversal tabs. There are no red exhaustion bars or bearish exhaustion bars. So I'm not going to touch anything. I'm not going to do anything about that. I'm going to just let that go. I'm going to completely ignore it. And now I've got my trades. I'm building a buy position. And the question becomes, how do you get, if you're building a long-term position, how do you get a profit target on a long-term commodity trade or something that you want to hold on to for a long time? Well, I'm going to show you exactly how I would do that. We'll use some long-term charts when we come back tomorrow, and we're going to talk about long-term profit targets on trades that you're holding for a long time. So that's what we'll do when we come back. Thanks for being here. Thanks for joining us. I'm Rob Booker, and we'll see you tomorrow. Thanks for being here, everybody.